The US government shuts down, so what does that mean for the markets? The US federal government has entered a shutdown with no obvious way out of a political impasse over the budget. The shutdown will likely delay the release of the jobs report set for this Friday and furlough 750,000 federal workers, costing $400 million a day. But shutdowns haven't historically bothered the market. During the last one, which lasted more than a month at the end of 2018, Wall Street actually rose. Joachim Klement is head of strategy at Panmure Liberum. Joachim, could this time be different?
I don't think that equity markets will be particularly vulnerable in this period of time. I think it is much more important in this case to look at the dollar and at treasury markets, because the longer the shutdown lasts, the more clear it becomes to everybody that the US is unable to get its fiscal deficit in order.
So what are you expecting from the bond markets?
We do expect that long-term bond yields will continue to drift higher. We already see today, as futures are opening, that the bond yields are drifting a little bit higher, while the dollar is a little bit softer.
We do also expect this to delay the release of key statistics, including the jobs report this week. What impact could that have?
Especially the jobs report is crucial to have these days, because that is the key driver of expectations for what the Fed will do. And if we see a delay there, that would probably not be digested well by the market. However, I'm quite optimistic that we will see most of the important data that gives us an indication of where the US economy is heading, like the ISM today, which is not a government entity. That will still be released. So investors can still get a good idea of where the economy in the US is heading.
But if this is not resolved for some while, perhaps not before the next Fed meeting at the end of the month, what does that mean for policymakers?
Then policymakers are literally driving in the dark and trying to find their way without any data to support their opinions. That would be very, very bad. And I think the Fed in this case would likely resolve to stay put in their November meeting.
President Trump has also threatened to lay off a significant number of federal workers permanently during the shutdown. Could this be a potential shock to a labour market that already looks weak?
It could well be a shock to a labour market that is weak, but let's face it, Donald Trump and the White House may want to fire those people, but the work doesn't go away. So I don't know what the point is of firing more government staffers when you already have let go so many this year.
Are you worried, though, about the US labour market with the data that we already have?
I think there's definitely some good signs, some signs of softening in the labor market. I don't think that this is reflecting badly on the overall economy. If you look at other consumer data like retail sales, they have all been very strong. So it seems a little bit like the US at the moment is two economies in one. There is the economy of, say, the upper 20 to 30% of households with the highest income. They're doing just fine and they're dominating the overall economic statistics, while a lot are struggling. But that you only see in the labor market data.
If a shutdown drags on, though, do you expect investors to start losing confidence in the US economy and to see this particularly in the FX markets? Will we see the dollar move lower?
I think we will see the dollar move lower as a reflection of investors being more and more worried about deficits and the long-term fiscal outlook for the US. However, losing confidence in the US market is a different story, because the confidence in the US market is very much driven by the AI boom and by the dynamism of US corporations. And that isn't going away anytime soon.
That was Joachim Klement of Panmure Liberum. Don't forget, you can watch more videos on Reuters.com.